Every month, one person writes a check to their landlord. The other writes a much bigger check to the bank. Most people think they already know who's making the smarter financial decision. But what if they're both wrong? Because buying a house can make you a millionaire, or it can quietly become the worst investment of your life. And renting? It might actually build more wealth than owning a home. Today we're going to settle one of the biggest financial debates in America, using math instead of emotion. If you've ever heard someone say, renting is throwing money away, or buying a home is always the best investment, you're not alone. These phrases have been repeated for decades. Parents say it, friends say it, real estate agents definitely say it. But here's the problem. Most people never stop to ask one simple question. Is it actually true? Because if buying a house automatically made people rich, every homeowner in America would be wealthy. Clearly, that's not how it works. Today, we're separating facts from financial myths. By the end of this video, you'll know exactly when renting makes sense, when buying makes sense, and which decision could save or cost you hundreds of thousands of dollars. Why this decision matters. Buying a home isn't like buying a car. It's probably the largest financial decision you'll ever make. The median existing home price in the U.S. has remained above $400,000 in recent years, while mortgage rates have stayed much higher than the ultra-low rates people saw during 2020-2021. That means the monthly cost of buying has increased dramatically for many families. A single decision can determine where hundreds of thousands of dollars go over the next 30 years. Yet most people make this decision emotionally, not financially, because owning a home feels like success. The American dream. A white picket fence, a backyard, a place to raise your kids. There's absolutely nothing wrong with wanting those things. The problem begins when emotions replace math. The biggest myth: rent is 100% wasted. You've probably heard this your entire life, but let's test that statement. Imagine two people. John rents an apartment, Sarah buys a house. John pays rent every month. Sarah pays a mortgage every month. Who is throwing money away? Most people instantly answer John. But here's something almost nobody realizes. Sarah's mortgage payment isn't building equity as fast as people think. In the early years of a 30-year mortgage, most of the payment goes toward interest, not ownership. That means thousands of dollars every year are effectively the cost of borrowing money, money that never comes back. And that's before property taxes, home insurance, HOA fees, maintenance, repairs, or replacing a broken roof. Suddenly, buying doesn't look as simple as social media makes it seem. Why people get this wrong? Humans are emotional. Money is mathematical. Those two don't always agree, we see. Homeowners becoming wealthy and assume the house made them rich. But often, they became wealthy because they consistently invested, built successful careers, saved money, and stayed in one place long enough for their home to appreciate. The house wasn't always the reason. Sometimes it was simply along for the ride. That's a huge difference. The real numbers, setting up the comparison. Let's stop arguing and start calculating. We're going to compare two people living in the same city, with the same income, same lifestyle, and same apartment quality. The only difference is this: one rents, one buys. Pay attention to something most videos completely ignore. Not just the monthly payment, but where the money goes after it leaves your bank account. The buyer's numbers. Sarah buys a $425,000 home with 20% down, $85,000. Financing $340,000 at 6.5% over 30 years. Her principal and interest payment is about $2,150 a month. But that's not the real payment. Add property taxes, $350, home insurance, $150, and a maintenance reserve, $350. And her total monthly housing cost comes to $3,000. That maintenance number matters. A good rule of thumb is 1% of the home's value per year, about $4,250 annually on this home. A new roof can run $12,000. HVAC replacement, $8,000. A water heater, $2,000. Homeownership isn't a fixed expense, it's a subscription with surprise charges. The renter's numbers. John rents a similar home for $2,300 a month, and that includes maintenance. If the roof leaks, he makes a phone call. If the air conditioner dies, it's not his problem. At first glance, John is saving $700 a month compared with Sarah's ownership cost. Most people stop here and say, sure, renting is cheaper monthly, but Sarah is building equity. That's where things get interesting. How much equity is Sarah really building? Sarah pays $2,150 a month toward principal and interest. How much of that reduces her loan balance in year one? About $3,800 total. Out of $25,800 paid over the year, only about $3,800 becomes equity. The other $22,000 is mostly interest. In year one, Sarah spends roughly $22,000 in interest, $4,200 in property taxes, $1,800 in insurance, and $4,250 in maintenance, over $32,000 in housing costs that do not build equity. John's annual rent is $27,600. Suddenly, the homeowner is spending more than the renter, even before we talk about investing. The opportunity cost, remember Sarah's $85,000 down payment? That money is now locked inside the house. John keeps his $85,000 invested in a low-cost S&P 500 index fund. Historically, the U.S. stock market has returned about 10% annually before inflation, or roughly 7% after inflation over long periods. Thoughtful. If John invests that $85,000 and earns 7% annually, after 10 years it becomes roughly $167,000, a gain of about $82,000 without owning any property. And remember the extra $700 a month he was saving? If he invests that too, the gap becomes much larger. The 10-year scoreboard. Let's be conservative and assume the home appreciates 3% a year, rent increases 3% a year, and investments earn 7% a year. After 10 years, Sarah, the buyer, has roughly $270,000 in equity. John, the renter who invested the difference, has roughly $300,000. The renter is ahead. In this example, that's because John invested both the down payment and the monthly savings. This is the part that shocks people. A house is not automatically a better investment than the stock market. You have to compare the house with what you could have done with the money instead. That's called opportunity cost, and it's one of the most important concepts in personal finance. But don't declare a winner yet. Before renters start celebrating, hold on. This comparison changes dramatically if Sarah stays in the house for 20 or 30 years. Over time, more of each mortgage payment goes toward principal. The loan balance shrinks faster, rent keeps rising, and eventually, Sarah could have no mortgage payment at all. That's the long-term advantage of buying. The first 5 to 10 years are often the hardest. The last 10 years can be incredibly powerful. So the real question becomes, how long do you plan to stay? If you move after 3 years, buying can be a financial disaster. But if you stay for 30, it might become the foundation of your wealth. The cost nobody talks about. There's one expense that catches almost every first-time homebuyer by surprise: the costs before you even move in. Buying a home doesn't just require a down payment. You'll also pay closing costs, loan origination fees, a home inspection, an appraisal, title insurance, and recording fees. Depending on the home, these can easily add another 2% to 5% of the purchase price. On a $425,000 home, roughly $8,500 to over $20,000 before you've unpacked a single box. And when you eventually sell, you'll likely pay agent commissions and other selling expenses that can consume another 5.6% of the sale price. Buying a house isn't just expensive to own, it's expensive to buy and expensive to leave. The flexibility factor. Money isn't the only thing that matters. Freedom has value too. Imagine your dream job suddenly appears across the country. If you're renting, you finish your lease, pack your bags, and start your new life. If you're a homeowner, now you have to find a buyer, pay selling costs, hope the market hasn't declined, and maybe carry 2 housing payments for months. Homeownership gives you stability. Renting gives you flexibility. Neither is automatically better. It depends on the life you're trying to build. When buying wins. Buying a home can be one of the best financial decisions you'll ever make, especially if these 5 things are true. You plan to stay at least 7 to 10 years, giving your home time to appreciate and spreading out the buying and selling costs. You have a stable income, since a mortgage is a long-term commitment. You have a healthy emergency fund because when something breaks, you're the repair department. You're buying a home you can comfortably afford, not the biggest house the bank says you qualify for. And you're buying because it fits your life, not because someone told you renting is throwing money away. When those boxes are checked, buying often becomes a powerful, long-term wealth-building tool. When renting wins. Renting is often the smarter financial decision if you're likely to move within the next few years. You don't have enough savings for a solid down payment and emergency fund. You're carrying high-interest debt like credit cards. You can invest the money you're not putting into a house. Or home prices in your area are so high that renting a similar property costs far less each month. Renting isn't wasting money. You're paying for a place to live. Just like buying isn't free, you're paying for financing, maintenance, taxes, insurance, and flexibility, or the lack of it. Housing is a necessity. Not every dollar you spend on housing is an investment. The big lesson. Here's the mistake millions of people make. They compare rent against a mortgage payment. That's the wrong comparison. The real comparison is the total cost of owning versus the total cost of renting plus investing the difference. Wealth isn't created by owning a house. Wealth is created by consistently owning appreciating assets, avoiding unnecessary debt, and making smart long-term decisions. Sometimes that's a home. Sometimes that's a diversified investment portfolio. And sometimes it's both. Final verdict. So, should you rent or should you buy? The answer is, neither is always better. Buying a home is a fantastic decision if you plan to stay for years, can comfortably afford it, and understand all the costs that come with ownership. Renting is a fantastic decision if it gives you flexibility, keeps your monthly costs lower, and allows you to consistently invest the money you save. The biggest mistake isn't renting. The biggest mistake isn't buying. The biggest mistake is making one of the largest financial decisions of your life based on emotion instead of math. If this video changed the way you think about money, subscribe to Finance with Ellis, because every week we break down complicated financial decisions into simple, practical lessons that can help you build real wealth. Would you rather rent or buy in today's market, and why? Drop your answer in the comments. I'll be reading every single one. Thanks for watching, and I'll see you in the next video.